All right, Huber, good to be back with you. And welcome everybody on LinkedIn Live, YouTube, or watching later to the StackSource monthly commercial real estate capital markets update. It is October 2023, so we're reviewing what happened and what we need to know about September 2023 in the capital markets and our outlook moving forward. Huber, how are you doing tonight?
Doing well. Excited to get into it. We have a lot of good updates this month and excited to reach out and talk to some of our viewers out there. Thanks for having me.
Awesome. Amazing. So we'll start first with news and events from September. First up, there's been a lot of talk in the news about inflation. It's not dead. The Consumer Price Index, which had gotten as low as 3% a couple of months ago, in September, we got a report about August CPI, and it's back up to 3.7%. So there is a long-term agreed target at 2% inflation as far as the Federal Reserve is concerned, that we'll be talking a little bit more about. As far as the Federal Reserve, they did have a meeting in early September. They are pausing and assessing. So there was no increase in the Fed funds rate, which means no increase in the prime financing rate. And monetary policy has stayed still as the Fed considers what to do next and where the economy is headed next. And finally, on the real estate side, funds being raised right now are really targeting distressed commercial real estate assets. So fund managers are pitching LPs. So LPs may be pension funds or high net worth investors on the retail side or family offices. They're pitching them on distressed asset acquisition opportunities. So assets that may be over levered, in default, struggling to recover. And this is what funds are pitching to LP investors today to raise funds for these types of acquisition opportunities in the months and the next couple of years to come. As we look at the rate changes, Huber, I'll pass it over to you for what you see here after inflation, which I mentioned, ticking back up a bit.
Great. So yes, as you had mentioned in the last slide, it was a very welcome sign to see that the Federal Reserve was willing to pause and wait and assess as more data came in. Here on our rate charts, which we show every single month, we're showing for you how it's changing month through month here. And that green top line is inflation. As we all know, the Fed is very sensitive to the movements in inflation. So while for the last couple of months, previous to the last 2-3 months, it was a welcome sign to see inflation going down, it is a bit concerning to see for the last 2 months here that we've been tracking inflation starting to jump back up. As I'm sure we've all been tracking, a lot of that has to do with oil, but we are going to be interested to see in the upcoming Federal Reserve meeting what they decide to do with this new data of inflation tracking, or which part of inflation is it core inflation that they look at, different types of inflation, stripping out different types of items there. So it'll be interesting to see, and I'm sure we'll all be tuned in to see how does this new data of inflation ticking back up, how does it affect the Federal Reserve's next decision? Do they pause again, or do they increase to try to taper that as well? What is a welcome sign is with other rates that we're tracking when it comes to 10-year, 2-year, especially with the 2-year and maybe term SOFR, you're seeing it a little bit flatten out, which is a welcome sign to maybe this time around last year, 2022, where it increased rapidly. So it's a welcome sign to see those rates kind of starting to taper out. But of course, those will be sensitive to what is the Federal Reserve's next decision. So stay tuned. For sure, next month we'll have a lot more for you when it comes to rate changes, and we'll have this graph updated for you as well. On our next slide, we're about to go into some of the different loan program types. So you see this every single month from us as we track the different ranges. So if you wanted to get an update on this prior to our monthly webinar here, we always include our website down below. If you go to stacksource.com, you'll be able to see the actual commercial mortgage rates that we update daily for you. So that way you stay in the know in terms of the different types of loan program that you send it to, whether it be Freddie, Fannie, HUD, CMBS, regional banks, life co's, debt funds. You can see what types of interest rates they charge. And there's a spectrum here. There's a lower bound and an upper bound, because of course there's so many different things. Every single deal is specific whether you're asking for high leverage, low leverage, is it in the top market, a tougher market, is there a lease up play, is it stabilized, right? So hence why on more conservative pricing and more aggressive pricing, you can see here what the lower and upper bounds are per different lender type that you send it to. On our next slide, we're going to go over underwriting and deal structure. What did we see in the month of September? So there were three big themes that we saw. Number one was banks pausing or focusing primarily on existing clients. So a lot of times, whether it be regional banks or national banks, we mentioned it in the previous meeting here, our previous webinar, that banks really like seeing depository relationships, a focus on that. September, we started to see more banks pausing, slowing down, giving us guidance saying, hey, we're going to wait 30, 60 days. We're going to pause here. And current deal flow, current allocations are set primarily for our current clientele. That also led to, for the banks that were lending out, limited cash out. So a lot of times, clients are coming to us and saying, hey, I completed my value add strategy, or my property will appraise for X. Is there a way that I can get some type of cash out here? We say limited because while there are still lenders that are offering true cash outs, most lenders are wanting any cash out proceeds to be put back into the property. So business plans where, hey, we're asking for cash out and that money is going to be used for other CapEx improvements, something that enhances the lender's collateral. They love those business plans. They prefer those ones. It's a little bit harder when you say, hey, we're going to use this cash out for something different that's not going back and enhancing the lender's collateral, like we said. And lastly, number three, we're seeing common equity being extra cautious. So that could be in the form of JV, more co-GP type equity positions, or LP type equity positions. With preferred equity, mezzanine debt, with they expecting interest rates for the risk that they're putting into deals in the mid-teens section, we're starting to see common equity be a little bit extra cautious as well. When we say extra cautious, for deals that they are going to invest in, again, co-GP or LP, in lockstep with how senior lenders and pref, mezz, how their interest rates are going up to compensate for added risk. If they are going to lend these equity type players, then they're going to want a higher return on their deals to compensate them for the risk where they're at in the capital stack. So we are seeing that these equity type investors, they're continuing to be more cautious or extra cautious as they view deals.
Makes total sense, Huber, and thanks for covering underwriting and deal structure that we're seeing. As far as the months ahead, a few things that our eyes are on. First, the end of October through the 1st of November, we have the next Federal Open Market Committee meeting. So this is the Federal Reserve meeting, voting, and announcing their next Fed funds rate decision. There are some that think they're going to raise the Fed funds rate again to continue to combat this inflation that's stubbornly above 3% at that 3.7. Others believe they're going to pause. A lot of talk in the news about this higher for longer interest rate environment. And that's the Fed funds rate, but that's also these treasury yields, as we saw the 10-year treasury yield rising. Second, cash in refis or distressed sale decisions. So we mentioned funds are pitching LPs on potential distressed acquisition opportunities. And that's because there are a higher percentage of loans and properties that are in, if not a default, in a difficult to refinance or a difficult to sell at the value they'd like type of scenario. And so there's going to be these options for real estate investors to either cash in refinance, either by making a capital call or bringing their own capital to the table, or through partnering with preferred equity investors, or to sell at a price that they may not prefer, but what liquidates and preserves some capital for their investors. And so that's what we're expecting to see in the months ahead. Upcoming reading for GDP is coming up in a couple of weeks, later in October, to see what the Q3 growth number is. I think the consensus is in the high 4s on a nominal basis as far as year over year GDP growth. Of course, if we subtract that 3.7% inflation number, you're closer to a 1 to 1.5% growth on a real GDP basis. Let's see. I mean, if it comes in below expectation, I think you have high rates and lower growth, and that's something that market can react very negatively towards. So that's what we're going to be keeping an eye on this month and the next couple of months ahead to gauge where real estate investors are, to gauge where property values may go, and what's going to happen next in this market. Okay, as we head towards the home stretch here, if you have questions that you'd like Huber and I to answer, and you're on LinkedIn Live or YouTube, please go ahead and leave them in the comments. We'll be collecting those as well as questions we received ahead of time and answer a couple of questions at the end. But first, StackSource. So Huber and I are executives at StackSource. We are a nationwide team of capital advisors. We have capital advisors in major markets that are advising commercial real estate investors on their financing options, whether that be debt or equity or a structured capital stack, to achieve the highest possible rate of return on their investment. So we operate with transparency, and we aim to offer competitive terms through our online portal. All right. So as we get to the question and answer, continue to drop those in the comments. If you are missing this and you are watching it live, if you're not watching it live and you're watching this later, hello@stacksource.com is a great way to get in touch with us, and you can be in touch with the capital advisor on our team. All right. Looks like we do have some questions coming in from LinkedIn specifically. Joe asks, where do we think values and cap rates will be for multifamily in the next 5 years? Okay, let's go ahead and polish off the crystal balls here. Huber, do you have a 5-year outlook for multifamily?
Look, the 5-year outlook is that I think most will hope and be in agreement where that rates will stabilize. That at some point rates, right now we're on the upper trajectory because of inflation. At some point that should be tamed and rates should stabilize. So in 5 years, it's very hard to say, are we higher for longer? Are we going to maintain this level of interest rate where indeed cap rates are, we're already seeing that price discovery, cap rates are continuing to rise. So I can only say that they'll be higher than what they were, in my opinion, than what they were maybe 2 years ago. I think 2020, 2021 with ultra low interest rates, unless somehow that comes back again, but that'd be very fast movement. I think that they will be higher than what they are today because we're currently in price discovery mode. But in the next 5 years and 5 years down the line, multifamily specifically, very tough to say. As you probably guessed, the answer lies in it's going to be very market dependent. Where are jobs flowing? Where are people going to? Where is the money chasing, right? That's what's going to cause like real demand to go up. And as that happens, then cap rates can compress. But if it follows the current theme of higher for longer, then they'll be higher than where they are today. But where exactly, I don't know. How about you, Tim? What do you think?
I'm going to piggyback on that and say there are some really good tailwinds for the multifamily asset class. And the biggest one of all is the need for housing and housing availability in the country. So I think not only do people need housing and they're willing to use their finances to make sure they have the housing they need, but I think through the collective community as well as the government are all really trying to support that drive to make sure people have sufficient housing. And that is a huge tailwind for the multifamily market. And I don't think it'd be really difficult to imagine multifamily among other real estate asset classes struggling on a 5-year basis. That's the good side. Now, the more conservative side in me would say, you're probably right about cap rates being at a really compressed place, like a last couple of years, and that's come back down to earth this year. It's hard to imagine that cap rates will do anything but rise, and I think it's a mistake. I think it's a rookie underwriting mistake to model into a multifamily acquisition or investment that cap rates will compress. I think you have to model in sort of expansion to cap rates, especially now as interest rates are rising. And if your deal doesn't pencil with an expanded cap rate, you should really think very closely about that multifamily investment.
Yeah, no, I agree. And Tim, moving on to a question here, one that came in a little bit before the program here. How does the recent CPI increase to 3.7% impact commercial real estate investment decisions?
Right. Okay. So CPI is a consumer price index that we're measuring. Now, that doesn't directly impact a multifamily or commercial real estate income statement, right? What it does is it signals to investors we're above that 2% long term target. And the Federal Reserve is probably going to continue to tighten or hold monetary policy rather than loosen it. And that's a scary thing because cap rates could expand and interest rates can make it more expensive to buy a property. And I think that's the biggest effect rather than any individual thing that's happening like on an income statement or an NOI of a property. So I think it's a negative signal to see that hiking back up in a way that just kind of spooks and freezes the capital markets. The transaction volume is down this year. As long as we've had this uncertainty around is inflation getting back down to normal, are interest rates going to stabilize? As long as the economy is not certain that interest rates are fairly stable, transaction volume is going to be low, and there's that worry that property values could fall. Another one that we had in the queue, Huber, I'd love to ask you this one. What should potential investors consider when looking at distressed asset opportunities, which we were talking about on the fundraising side?
Yes, and you had touched one of the answers in the previous question about the rookie mistake of putting in more conservative, or excuse me, a really aggressive cap rate assumptions there. But to start and break it down, when it comes to distressed asset opportunities, I mean, when you're going into it as an investor, you need to ask yourself, okay, it's distressed for what reason? Why wasn't the current? These are questions that lenders are going to ask too, and we're seeing that more and more with lenders here. When you look at the previous owner of the property, what were they trying to accomplish? Why are they selling it? What put them into this distressed position? And then what is your business plan as the new owner of the property, someone taking it over? Is it going to be different somehow? Do you have something that they didn't have? Maybe it's your expertise, your knowledge, your team around you, other assets that you might have at your disposal. But they want to make sure that, hey, if you're coming in and they're going to be a lender for you and they're going to come in and help you purchase this property or take down this distressed asset. Are they catching a falling knife, to use that metaphor? Are they coming in and you're going to try but fail, and then they're in a tough position as well? So I'd say that when it comes to potential investors that are considering these distressed asset opportunities, these potential purchases that are coming on the market, I would caution and say really use conservative underwriting here. Are there more recent comparables, something that's traded? Because again, like we talked about, we're currently in a price discovery mode. So using something that traded, a sale that traded, or a lease comp that traded 6 months ago, even 3 months ago now, it's going to be very different. Things are moving so fast in this. Things are changing so fast in this current capital markets that we have. You're seeing it all the time, the volatility in the market. So do you have something that traded in the last week, in the last couple of weeks to help you with that? If not, then I would caution to be as conservative as possible and not underwrite where you are hoping things to go. You should underwrite to where they are currently, or maybe take a more downward case scenario. And if the deal still pencils there, then awesome, it's a great deal. And if not, then that's your opportunity to negotiate for even a lower price, because again, these are distressed asset opportunities. They need to get out for some reason. So it is your opportunity to negotiate the best price for yourself in order to make sure you have enough room there to cover you in case some of your base case assumptions don't work out. And then of course, if they do work out, or if they're better than expected, then it's great. Then you're in a much, much better position. So that would be my advice to some potential investors that are looking at these sales that are coming up, the distress sales, really asking the question, what was it that the seller, the previous sponsor, was trying to accomplish? And how is my business plan different? What am I going to do differently here? Yeah. Cool. So one of the other ones that we had teed up from before, this one was for Tim. Are there any specific sectors, Tim, within commercial real estate that are more or less affected by these current economic conditions we're talking about?
Today, office properties are the clear doghouse resident. I mean, offices never got back to the physical occupancy that they had pre-COVID, even before this recent economic uncertainty. And if we do enter a recession in this next period to come, and offices really never got back to their physical occupancy. Now, there are office properties in New York and San Francisco and other major markets where the rent roll actually might not look that bad. But if the employees aren't coming in, why is that tenant going to renew? Or why are they going to renew as much space? And so office is the biggest question mark, or maybe the least question mark if we're considering the fact that commercial properties, more broadly speaking, prices are falling this year. And so maybe they're the least question mark in that they'll probably fall even more or fall the most in these next several months, few quarters to come. Multifamily, we talked about. It's got long-term tailwinds. It probably got overheated in the last several years. Lots of retail investors, lots of new syndicators in the space. But I do believe in multifamily in the long term. But it's been a surprising soft spot as far as a year over year, being down more than double digits as far as an index basis from last year. I think the only lone bright spot in the market right now is the industrial asset type. Commercial property values are down across the board. Industrial is really holding its own. Multifamily has been harmed, but I think office is the clear loser. More questions coming in live from LinkedIn, and thank you. As long as we have some questions coming in, we can stay live here. Those that are engaged with us, thank you so much. We have a question about 10-year Treasury rates and their relationship with most or all interest rates, or specifically the 30-year mortgage rate. Huber, do you want to take a stab at that?
Well, we saw on the chart earlier, we can share that around later if you're interested, just messages on hello@stacksource.com, that these rates are kind of moving in lockstep here. As you see one rising, you're seeing them all tend to rise. And again, that is a byproduct of inflation and the byproduct of the actions of the Federal Reserve. So regarding how the 10-year Treasury and the 30-year mortgage rates are, I don't really have a good indication in terms of, I just know that both are rising. Both are in that same bucket. But I won't have a very good economics breakdown in terms of how both are related.
Right. And because StackSource doesn't arrange residential mortgages, we don't have a good window into the 30-year fixed rate residential mortgage space and what those yields are like and what that origination looks like today. I can say the 10-year Treasury rate is very commonly used for banks, credit unions, and other long-term fixed rate lenders in our space, which has traditionally been the bread and butter of commercial mortgage underwriting. Banks, credit unions, then arguably CMBS after that. As far as short-term bridge loans, they're not really looking at 10-year Treasuries necessarily. It's closer to these overnight lending rates like a SOFR, secured overnight financing rate. Used to be LIBOR, now it's SOFR. And so as SOFR has risen, you have the bridge lenders rates rising, and that's an index they tend to use for some owner-occupied commercial property. So if you're a small business acquiring a property to operate and maybe using either SBA or conventional, those might more oftenly be tied to prime or another interest rate index. But yeah, the bread and butter of our space is tied to Treasuries, with 5-year fixed being tied to 5-year Treasuries, 10-year fixed being tied to 10-year Treasuries. And certainly in the commercial mortgage space, as we've seen that quick rise in the 10-year, even as the 2-year and the SOFR are fairly even in the last couple of months, the 10-year has really been rising. And that is making acquisitions and financing much more expensive if you're looking for a 10-year fixed rate product.
That's right. And yeah, something to piggyback on that is we're starting to start seeing a lot more of these traditional banks, credit unions, right? More of their quotes these days are more focused on the 3-year term, 5-year term, something of shorter duration. Simply because, again, a 10-year term very expensive. You don't know where things are going to be 10 years from now. It's much harder to predict. So we are actually seeing a lot more 3, 5, 7-year term deals coming from 10 years still available, but you're starting to see the popularity for 3 and 5-year terms from both the sponsor side and the bank side. You're starting to see that popularity increase.
And I think I overheard you say today, Huber, related to deal talk, rates in the 8s are now just par for the course, right?
Yeah, very weird to say. I'm sure a lot of us don't like hearing that. But of course, again, don't hear rates in the 8s like, oh my gosh, not every deal is in the 8s. We, in real time, StackSource is tracking these rates, certain types of lenders. And What we can say is earlier today, we saw 3 different banks all quoting 3 different types of deals come in that mid 8% range, where it was boom, 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 all after another. Different types of, yes, they were perm, they were types of deals that you would take to banks that were across the country, different areas. But it's very interesting to see that within like different deals, boom, you see it in the mid eights ranges. I'm like, man, is mid eights the new normal now, the new benchmark here that we're seeing? And below that is a great deal, and then above that is an opportunity for maybe getting something lower.
Right. We have another LinkedIn question regarding the timing once inflation cools enough to get to that 2% target that we've been talking about. How long can we expect the Feds to before they bring rates back down? Once again, we've got to polish the crystal ball here.
That's gonna be the hottest topic on most people's mind, because you'll look at maybe past Fed chairmen, past Federal Reserves, when things were in this of rising rates, trying to taper inflation, and people probably look to the past as a clue in terms of, okay, when we hit that 2%, when did they cool with it? When did these talks start to? Because it seems like every single month that is the talk of the town. What did inflation do? What is the Federal Reserve going to do? Right? When maybe if you were in this industry 5 years ago, it wasn't much of a, not really what you talked about. It wasn't more dominating the headlines this past year. So, yeah, Tim, crystal ball. I don't have that crystal ball. I don't have the data on what past Federal was. I assume most people will do that. Will look to the past for some sort of guidance. And I highly doubt that the Federal Reserve will actually give us a timetable. It's probably going to be one of those, we're going to continue to track the data. We're happy with the progress. We're happy that inflation's down at 2%, but we'll be continuing to watch if further federal actions are necessary.
Yeah. While this is a $1 trillion question, and I don't think I have particularly special insight here, the interesting chart to look at is the Fed dot plot. Right. So the Fed officials of each regional Federal Reserve branch, they each plot in the months to come, and then in the next year, and then in the long term, where they think the federal funds rate is going to be. And each Federal Reserve meeting, there's a new Fed dot plot that comes out, which shows each of these Federal Reserve officials expectations for where rates will be, but they change each time. So it's really hard to say. It's really a spot check on what the Federal Reserve officials think the future is going to look like. The market looks at this pretty closely. It's a good thing to Google if you haven't seen it, I guess, is where I'd go with that.
Gotcha. And Tim, there's another question that came in here that kind of has to do with one of the questions you talked about earlier in terms of multifamily versus office. But Aditya here asks, what are your thoughts on the changes in the market trend, i.e. slowing transactions in multifamily versus opening up office space? And he mentions office has been losing up until now, but is this a trend indicative of the future?
No, I mean, so trends in the past are always not really good enough to indicate what's going to happen in the future. And so you try to look at all the signals holistically, and that's where multifamily really does have these long-term tailwinds. People need housing more. It can be argued more than they need to go to an office, right? Especially with the work from home trend, you'd think that especially helps, suburban multifamily a lot more than it does core office. And so these are trends that can be observed. I think the physical occupancy being lower is kind of an indication of what might happen for the rent roll official occupancy of a building in the future. And that's why I'm cautious on office for the next couple of years to come. And I think there's probably a full reset coming for office values. But next month is going to have different news, and next quarter is going to have different news. And so that's what we're seeing. And we also, our perspective is colored by how lenders, preferred equity investors are responding live to different capital requests that are going through our marketplace. And so that's really a little bit of our opinion and a little bit of general consensus from the real estate capital markets right now. But unfortunately, I don't know that we can, especially when it comes to timing. Timing is even more difficult to predict than direction. And so that's not something that I'd venture to have confidence in. All right. Well, I think we've hammered a number of questions. If you have a question about a specific property, if you have a question about a specific portfolio, that's where StackSource Capital Advisors can help. hello@stacksource.com or visiting stacksource.com can get you in touch with us, with our team, Huber and I. We aren't too LinkedIn famous to check our own email and respond, and we like to respond to every email. Huber may be at inbox 0 more often than I am, but please do reach out if you'd like to talk about commercial real estate finance. If you need to identify the right capitalization for your asset or your portfolio, we'd love to chat. And we will be here each and every month, LinkedIn Live and YouTube. Thank you, everybody, for chiming in, and we'll see you next month.
Yeah, thank you, everyone.